Our top story this hour. We have an extremely smart lady coming up. Dow futures up this morning as investors wait to see if the Fed decides to raise interest rates for the fourth time this year. Look who's here, MacroMavens President Stephanie Pomboy. Before you walked on set, I said, when you sit down, you take credit for what you've called this year, because now everybody's talking about what you were sitting on this set talking about in January.
Well, I really appreciate you acknowledging that. I wasn't a very popular lady. Didn't get a lot of cocktail party invitations with my outlook for the economy. But as you and I have talked a lot about, Dagan, my whole argument has been that in the focus on the impact of the tax cuts and fiscal policy on the economy, what was happening behind the scenes with quantitative tightening was being totally ignored. Meanwhile, that was progressing on a regular schedule. I think I told you my analogy for it was sort of like being told you're going to get punched in the face every month, as if that somehow made it less painful when you actually did get punched in the face. But because the quantitative tightening was kind of happening on autopilot and it really wasn't front and center, I think that the markets sort of just assumed that it was some innocuous program. Meanwhile, credit, upon which the U.S. economy depends, has been receding. And you've seen, like, in the corporate bond market this year, issuance has slowed dramatically, and it hasn't just slowed in the last few weeks. It's been slowing all year. If volume precedes price, then that was an indication that, things were going to start to bubble to the fore as they have now. So I'm not surprised that there's now this talk about how the Fed might actually pause next year. I think the real surprise next year will be not only do they pause rate hikes, but they pause the quantitative tightening, mostly because generally by the time they pause rate hikes, the time span between when they stop tightening and when they first cut is 6 months on average. 6 months, that's nothing. That means if this is their last hike today, they could be easing by summer. But there's no point in cutting rates if you're simultaneously shrinking the balance sheet.
Right, pulling $50 billion a month out of the financial
Exactly,
system.
Which I would argue maybe has an even more profound impact on the credit mechanism.
Do you think that we're looking, because you've been predicting like the turbulence in the stock market that we've seen in the last couple of months because of all of the things you just mentioned, you've been seeing this early for months and months and months. Going into next year, do you think that, well, one, is it possible that the Fed does not raise today, number one? And number two, are you seeing a recession?
So on the first one, I mean, there's certainly a possibility. I think the possibility would have been much higher had the market done another 600-point down day yesterday.
Right.
But, yesterday's trading and the futures today, make that probably pretty low odds. I think the expectation for a hike today is 70%, right, basically. As to whether we have a recession, I have always maintained that the precipitating factor for a recession would be a correction in the financial markets.
Absolutely, you've been saying that.
And I think
I mentioned it just a minute ago, but the Russell 2000 small cap stocks, which are very U.S. focused, are in a bear market.
Well, this is the thing. This is the story that's been happening behind the scenes that no one's focused on. You talk about being a nerd. I'll one-up you in nerddom. On the profit front, we all sit here and we focus on the S&P earnings numbers. And, that's where they look at the PE ratio on the markets and judge valuation. Meanwhile, the government, this is a really nerdy realm, comes up with their own profit measure, which is part of their quarterly GDP report. Their profit measure obviously covers the entire economy, not just the top 500 companies that we all focus on myopically. Their measure of profits has been much slower than the S&P numbers this year. In fact, their before-tax earnings numbers, which is an indication of what we can expect to see when the tax cut effect rolls off next year, are negative year on year. They've got profits down 1% on a before-tax basis year on year. So those numbers are completely out of the realm of anything people are seeing on Wall Street. But my point is, even if we're somewhere in between, you got 25% on the S&P earnings and you've got 7%, from the government. If we're somewhere in the middle this year, I think people are going to be surprised. And I guess what I'm getting to on your small cap point is that we've been focused on these very narrow, the picture we've been seeing is really the top part of the pyramid, and meanwhile, a much broader swath of the economy hasn't seen the type of benefit from the tax cut and this type of momentum that's reflected in the top stocks. Even in the S&P 500, the top 20% of companies accounted for 70% of the earnings growth last quarter. The bottom half of companies accounted for 9%. That's in the biggest 500 companies in the country. So you could see where, if you take an even broader picture, things really aren't quite as fabulous on an average basis.
So, Stephanie, so it sounds like if you expect recession next year and you think that's highly likely, it's going to be those profitable companies accounting for 70% that are going to have the bottom fall out. 70% is an interesting number. It's also roughly what personal consumption makes up of GDP, roughly, give or take a couple of points. Is that where we might see this, like the surprise to consensus in personal consumption? Is that where the floor is going to fall out? Is that a big part of what you're seeing?
Well, I think that personal consumption has been slowing. I know that the numbers, you get these quarters where it's stronger and weaker. I mean, obviously nothing goes in a straight line. But if you look at the discretionary portion of spending, people have really had to adjust their consumption because debt service has been going up for them since December 2015. The corporate sector enjoyed lower borrowing costs even as the Fed was raising rates. That didn't happen for the consumer sector. Debt service payments are up substantially over that 3-year stretch. So they've had to cut back on discretionary spending. I mean, you've seen it in things like interest-sensitive areas. Housing, volume is down 5%, prices down 6%. Auto sales slowing, they peaked.
Aside from housing and auto sales, the worry seems to be about the slowdown in the future. And I'm curious how bad you think it could get, because Alan Greenspan was doing an interview with CNN, and he said run for cover. It's going to get really ugly. And you're also hearing people talk about stagflation right now, which is obviously a stagnating economy amid inflation.
Yeah, but
I know you have oil prices
there's
are down.
There's no inflationary pressure at all because the consumer. I know, but they're not looking at the numbers if they're saying that.
I mean, I think that worrying about inflation is a giant waste of time in an economy that's as levered as ours is. The tendency is to deflation, not inflation, and I think that's going to be the problem here. Is if we've seen the peak in the cycle, which I think we have, we've seen the peak at incredibly low rates of inflation, incredibly low wage growth, relatively speaking. So I don't really worry about stagflation. And I also think, yes, I have concerns about the consumer sector in terms of slowing and trouble servicing debt at the low end. But I think the real issue is going to be in the corporate sector, where the leveraging up has been unprecedented, and they've got $800 billion in that debt that rolls next year in a market that's seizing up already. So that's going to be a source of lots of entertainment next year.
We've got to come back after. Well, we'll come back soon.
Okay.
Very soon. An email. Stephanie,
will do.
Great to see you. Stephanie Pomboy.
Merry Christmas.
Merry Christmas. Merry Christmas, my friend.